Have you ever wondered why some people seem trapped in an endless cycle of working, spending, and barely getting ahead, while others quietly build wealth and escape the rat race entirely? What if I told you that the difference isn't luck, inheritance, or some secret knowledge available only to the wealthy elite? The truth is, there are specific financial behaviors that act like invisible chains, keeping ordinary people locked in mediocrity while their money slowly bleeds away through seemingly harmless decisions. My name is Nick, and I help people understand how small financial choices create massive long-term consequences. If you're tired of feeling like you're running on a financial hamster wheel and want to discover the hidden traps that might be sabotaging your wealth building efforts, make sure to subscribe to the channel and hit the like button if this information helps you break free from these costly mistakes. Here's something that might surprise you. According to recent studies, the majority of middle-class families are living paycheck to paycheck despite earning decent incomes. This isn't just about people working minimum wage jobs or struggling with unemployment. We're talking about families with college degrees, professional careers, and what appears to be comfortable lifestyles on the surface. Yet underneath all those nice cars and suburban homes lies a troubling reality. They're financially fragile, one emergency away from serious trouble. But what's even more shocking is that most of these people have no idea they're trapped. They've fallen victim to what I call middle-class money traps, subtle financial behaviors that seem reasonable or even smart in the moment, but systematically destroy wealth over time. These traps are so common and socially accepted that questioning them feels almost revolutionary. Today, I'm going to expose the most dangerous of these wealth-destroying habits, starting with some that might seem harmless but are actually costing you tens of thousands of dollars over your lifetime. By the end of this video, you'll understand exactly why so many seemingly successful people never build real wealth, and more importantly, how you can avoid their fate. Before we dive into the specific traps, let me paint a picture of what financial freedom actually looks like. It's not about driving luxury cars or living in mansions. Real wealth is having options. It's being able to take calculated risks because you have a safety net. It's choosing your career based on passion and growth potential rather than just immediate paycheck needs. It's sleeping peacefully at night knowing that your money is working for you, creating more money while you focus on the things that truly matter in life. Now, contrast that with the financial reality most people experience. They work 40 or more hours per week, yet their bank accounts barely grow from year to year. They might get raises, but somehow their expenses always seem to rise to meet their income. They feel like they're making progress by upgrading their lifestyle, but they're actually moving further away from financial independence with each passing year. The cruel irony is that many of these wealth-destroying behaviors are marketed to us as signs of success or smart financial moves. Society applauds when you buy a bigger house, get a newer car, or increase your standard of living. But what society doesn't tell you is that these decisions often represent the difference between building wealth and staying broke forever. Let's start with one of the most expensive mistakes that middle-class families make without even realizing it. This trap is so normalized in our culture that most people never question whether it's actually helping or hurting their financial future. The first major trap is what I call investment ignorance, and it's absolutely devastating to long-term wealth building. Here's the reality. The majority of people who participate in employer retirement plans have absolutely no idea what they're actually invested in. They sign up for their company's retirement program. Maybe they even get the employer match and then they completely forget about it for years or even decades. Think about how absurd this is for a moment. These same people would spend hours researching which television to buy, comparing features and prices for a purchase that might cost a few $100s. But when it comes to investments that will determine their entire financial future, they operate on complete autopilot. They let someone else make decisions about hundreds of thousands of dollars without understanding the first thing about what's happening to their money. The financial consequences of this ignorance are staggering. Let me give you a concrete example that will blow your mind. Imagine two people who both invest the same amount of money over their careers. Person A ends up with a portfolio worth $600,000 at retirement. Person B ends up with over $1 million. The only difference between them was the investment choices they made within their retirement accounts. That's not a small difference we're talking about. That's literally hundreds of thousands of dollars in wealth that was either created or destroyed based on investment decisions that most people never even think about. Yet, this scenario plays out millions of times across the country, with people accidentally choosing inferior investments simply because they never took the time to understand what they were buying. The problem goes deeper than just picking the wrong mutual funds, though. Investment ignorance also means falling victim to high fees that silently eat away at returns year after year. It means missing out on tax advantages that could save thousands of dollars annually. It means making emotional decisions during market downturns that lock in losses and destroy decades of wealth building. But here's what's really frustrating about this trap. It's completely avoidable. You don't need to become a financial expert or spend hours every day managing your investments. You just need to understand the basics well enough to make informed decisions about your own money. Yet most people would rather remain ignorant and hope everything works out somehow. This leads us directly into the second major trap that's keeping people stuck in the middle class: the addiction to active trading and market timing. Now, you might think this doesn't apply to you if you're not day trading stocks or checking your portfolio constantly, but this trap is actually much more subtle and widespread than most people realize. Here's how it typically unfolds. Someone starts paying attention to their investments, which is actually a good thing. They notice that markets go up and down, and they start thinking they can get smarter returns by buying when things look good and selling when things look bad. This sounds logical, and it feeds into our natural desire to feel in control of our financial destiny. The problem is that trying to time the market is one of the most reliable ways to destroy wealth that has ever been invented. Even professional fund managers with teams of researchers and sophisticated analytical tools struggle to beat simple index fund returns consistently. Yet somehow, individual investors think they can succeed where professionals fail, usually while managing their investments as a side hobby between their regular jobs and family responsibilities. The mathematics of market timing failure are brutal. Studies consistently show that the average investor earns significantly lower returns than the overall market, primarily because they buy high when they feel optimistic and sell low when they panic. They miss the best performing days because they're sitting on the sidelines waiting for the perfect entry point that never comes. Even more insidious is the way this behavior becomes addictive. Each small win reinforces the belief that you can outsmart the market, while losses are explained away as temporary setbacks or learning experiences. People end up spending enormous amounts of time and mental energy on an activity that statistically makes them poor, all while convincing themselves they're being proactive about their financial future. The transaction costs alone can be devastating. Every trade involves fees, taxes, and bid-ask spreads that chip away at returns. When you multiply these costs across frequent trading over many years, you're looking at tens of thousands of dollars in unnecessary expenses. And that doesn't even account for the opportunity cost of missing out on compound growth while your money sits in cash waiting for the next perfect opportunity. This brings us to our third trap, and this one is particularly painful because it involves the government taking more of your money than necessary. I'm talking about the complete failure to engage in basic tax planning, and it's costing middle-class families thousands upon thousands of dollars every single year. Most people treat taxes like the weather, something that happens to them, rather than something they can influence. They dutifully file their returns each April, pay whatever the software tells them they owe, and never give it another thought until the following year. This passive approach to taxation is one of the most expensive mistakes you can make as a wealth builder. Here's the reality that wealthy people understand, but middle-class families often ignore. Taxes are likely your single largest expense category. For many families, taxes consume more money than housing, transportation, food, and entertainment combined. Yet while they'll spend hours researching ways to save $50 on their monthly phone bill, they'll never invest any time in learning how to legally reduce their tax burden by thousands of dollars annually. The missed opportunities are everywhere. Retirement account contributions that could slash your current tax bill while building future wealth, health savings accounts that offer triple tax advantages, strategic timing of income, and deductions that could move you between tax brackets, real estate investments that provide depreciation benefits and other tax shelters, business structures that allow for legitimate expense deductions. But perhaps the most costly aspect of tax ignorance is the failure to understand how different types of income are taxed. Earned income from your job faces the highest tax rates, while investment income often qualifies for preferential treatment. Yet, most middle-class families focus exclusively on earning more money from their jobs rather than building streams of more tax-efficient income through investments and business ownership. The wealthy don't pay lower tax rates because they're cheating or exploiting loopholes. They pay lower effective tax rates because they structure their finances to take advantage of incentives that are available to everyone but understood by very few. They work with competent tax professionals who help them make strategic decisions throughout the year rather than just cleaning up the mess each April. This passive approach to taxes extends far beyond just missing deductions. It reflects a fundamental misunderstanding of how wealth is actually created and preserved. While you're focused on earning your next raise, wealthy individuals are focused on keeping more of what they already earn through intelligent tax strategies. The fourth trap that's silently destroying middle-class wealth is something I call change paralysis, and it might be the most psychologically challenging obstacle to overcome. This is the tendency to stay stuck in situations that are clearly not working simply because change feels uncomfortable or risky. Here's how this plays out in real life. You know your current job is underpaying you by 20 or 30% compared to market rates, but switching companies means dealing with new people, learning new systems, and giving up the comfortable familiarity of your current routine. You realize your living situation is eating up way too much of your income, but moving seems like such a hassle that you just keep paying the inflated rent month after month, year after year. Meanwhile, inflation is steadily eroding your purchasing power, your peers are advancing in their careers, and opportunities are passing you by. But change feels scary, so you convince yourself that stability is more important than growth. You tell yourself you're being responsible and conservative, when in reality you're being financially reckless by refusing to adapt. The mathematics of change avoidance are depressing. Let's say you could increase your income by 20% by switching jobs, but you put it off for 3 years because change makes you uncomfortable. On a $50,000 salary, that's $30,000 in lost income, not counting the compound effect on your retirement savings and the higher baseline for future raises. That's a pretty expensive comfort zone. But the real tragedy is that most people vastly overestimate the risks of change while completely ignoring the very real risks of staying put. They worry about what might go wrong if they make a move, but they don't consider what definitely will go wrong if they don't. Your current situation might feel safe, but if it's not moving you toward your financial goals, it's actually quite dangerous. This brings us to the fifth trap. And this one is particularly insidious because it's often disguised as responsible financial behavior. I'm talking about the refusal to purchase real estate when it makes financial sense, usually based on outdated advice or misunderstood market conditions. Now, I'm not suggesting that everyone should rush out and buy a house regardless of their circumstances. Real estate can be a terrible investment if you buy the wrong property at the wrong time, or if you're not prepared for the responsibilities of ownership. But for many middle-class families, the systematic avoidance of real estate ownership represents one of the most costly financial decisions they'll ever make. The numbers on this are pretty stark. According to federal data, the median net worth of homeowners is dramatically higher than renters, and it's not even close. We're talking about a difference of hundreds of thousands of dollars in accumulated wealth over a lifetime. Some of this difference is certainly due to other factors, but a significant portion comes from the forced savings mechanism and appreciation potential that real estate ownership provides. Here's what many people don't understand about real estate as a wealth building tool. When you pay rent, 100% of that money disappears forever. When you pay a mortgage, a portion goes toward interest, but another portion builds equity that belongs to you. Over time, as the loan balance decreases and property values typically increase, you're building wealth almost automatically through your normal housing payments. But the benefits go beyond just equity accumulation. Real estate provides inflation protection in a way that many other investments cannot. When the cost of everything else is rising, your mortgage payment stays the same, effectively becoming cheaper in real terms over time. Meanwhile, if you're renting, your housing else. The tax advantages can be substantial. Costs are likely increasing every year along with everything taxes are deductible, and if you ever sell your as well. Mortgage interest is deductible, property from taxation entirely. These benefits are available to every home primary residence. Significant capital gains can be exclude owner, but they're completely unavailable to renters. Yet despite all these advantages, many people convince themselves that renting is somehow the smarter financial choice. They'll calculate that they can rent for less than they could buy, but they ignore the wealth building component entirely. They treat housing purely as an expense rather than understanding it as a potential investment in their financial future. The sixth trap is perhaps the most counterintuitive because it involves avoiding something that most people associate with losing money: taking calculated risks. The irony is that by trying to avoid all risk, middle-class families often guarantee that they'll never build significant wealth. This risk aversion shows up in multiple ways. It's keeping all your money in savings accounts, earning virtually nothing because the stock market feels too dangerous. It's staying in a dead-end job because starting a business seems too risky, even when you have a solid plan and sufficient savings to cushion potential failure. It's avoiding any investment that might lose value, even temporarily, which means missing out on the long-term growth that creates real wealth. Here's the fundamental truth about risk that most people misunderstand. Not taking risk is actually extremely risky. When you keep money in low-yielding accounts, you're taking the risk that inflation will erode your purchasing power over time. When you stay in a low-paying job to avoid career risk, you're taking the risk that your skills will become obsolete or that you'll never reach your earning potential. The wealthy understand that intelligent risk-taking is not gambling. It's making calculated decisions where the potential rewards justify the potential losses and where you've prepared for various outcomes. They don't risk money they can't afford to lose, but they also don't let fear prevent them from pursuing opportunities that could significantly improve their financial position. This connects directly to our seventh trap, which is the destructive habit of rewarding yourself financially for working hard, regardless of whether you can actually afford those rewards. This might sound harsh, but stick with me because this behavior pattern is absolutely devastating to long-term wealth building. The psychology behind this trap is completely understandable. You work 40 or 50 hours per week, you deal with stress and difficult people, and you feel like you deserve some tangible reward for your efforts. So you buy yourself something nice, or you splurge on an expensive dinner, or you book a vacation that stretches your budget. After all, you earned it, right? The problem with this thinking is that it completely ignores the opportunity cost of those spending decisions. That $300 dinner might feel like a small reward for your hard work, but invested over 20 years, it could grow to over $2,000. That vacation that costs $5,000 represents tens of thousands in lost wealth when you account for compound growth over time. But more importantly, this reward-based spending often becomes a psychological trap that prevents you from ever building substantial wealth. Every time your income increases, your sense of what you deserve increases right along with it. You get a raise, so you deserve a nicer car. You get a promotion, so you deserve a bigger apartment, you have a good year, so you deserve an expensive vacation. This pattern ensures that no matter how much money you earn, you'll always find ways to spend most of it on lifestyle improvements rather than channeling it toward investments that could eventually free you from dependence on your paycheck entirely. You end up trapped in what's essentially a high-income lifestyle without ever building the assets that would make that lifestyle sustainable without constant work. Look, I know this has been a lot to digest, and you might be feeling a bit overwhelmed by all the ways your financial decisions could be working against you. But here's the thing that should actually make you feel hopeful. Every single one of these traps is completely within your power to avoid. You don't need to inherit money, win the lottery, or discover some secret investment strategy that only billionaires know about. The people who escape these middle-class money traps aren't necessarily smarter or more disciplined than you are. They just made different choices about how to handle their money, often starting with very small changes that compounded over time. They chose to learn about their investments. Instead of ignoring them, they embraced calculated risks instead of avoiding all risk. They treated tax planning as seriously as they treated any other major expense. The beautiful irony is that while these traps can keep you broke forever if you fall into them, avoiding them can set you on a path toward genuine financial freedom. The same compound interest that works against you when you're paying credit card debt works for you when you're building wealth through consistent investing. Your financial future isn't determined by your current income or your family background. It's determined by the decisions you make starting today. Which of these traps have you been falling into, and more importantly, which one will you start avoiding first? The choice is entirely yours, but I promise you this: your future self will thank you for making it.